Hi friends, welcome back to Cap Classes. Very good afternoon all of you. Today we are going to discuss for CMA USA students cost, volume, profit analysis. This is quite an interesting area, very significant when you apply this to a real life situation. If you are from, in your graduation, if you have studied costing, you might have seen marginal costing. So this cost volume profit analysis, CVP analysis, or we call break-even analysis, is nothing but a part of your management accounting. So first, basically we have accounting and then we have costing. From costing, one spin-off is there, management accounting. And in that management accounting, these decision-making tools are given, such as marginal costing, or you call it cost volume profit analysis, standard costing, budgetary controls. All these things are tools in the hands of managers. When you are pursuing CMA US, what you are going to become at the end of your academics, once you become management accountant, once you clear CMA US exams, your career is, you'll start your career as a management accountant, isn't it? So when you start your career as a management accountant, think about it. What is the primary, or your criteria, you call it, or the job, or the task, or the responsibility, or the purpose of management accounting? So what do you do? Do you remember when we discussed about the basics? I told you the main purpose of management accounting is decision making. The main purpose of management accounting is decision making. So as a management accountant, you are responsible to take various decisions for the company. And one very important tool in your hand that guides you to make effective, informed decisions is CVP analysis. So this is a part of your part 2, strategic financial management. In that we have so many sections, 6 sections. In that, this is section C, which is having 25% weightage. And this is again broken down. This decision analysis, which is section C, is again broken down into 3 different study units. They are: one, CVP analysis, which we are going to learn today, cost volume profit analysis. Next one is marginal analysis. Next one is pricing analysis. So without wasting time, let us start with cost volume profit analysis. Okay. So there is a lot of theory. What is CVP? What is break even? What is break even point? What is fixed cost? What is variable cost? And then we have given a beautiful diagram on the screen. All these things we'll see later. First, let us recollect our basic costing equation. So will you agree with me? Do you agree with me if I say sales, say for example, $100 less cost, for example, $70 will give you a profit of $30. Do you agree with me if I say sales minus cost is equal to profit? So what is the equation here? Sales minus cost is equal to profit. Agreed? So there is no confusion in this basic equation. For the purpose of marginal costing or cost volume profit analysis, cost is classified into, for the purpose of CVP analysis, cost is classified into 2. So here cost is classified into 2, namely variable cost and fixed cost. Now the question comes, what is variable cost? What is fixed cost? The meaning is simple. Any cost that moves, that changes, that varies with a given change in the production volume level of activity is called variable cost. That means I am increasing production, I am decreasing production, I am changing production. When the number of units produced changes, whether the cost is changing, if the answer is yes, it is a variable cost. There are certain costs which do not change with a given change in production. You produce more units or you produce less units, this cost will not change. That is called fixed cost. And the best example for fixed cost is rent. Fixed cost example: rent, advertisements. Advertisements. So consider a company like Unilever. Consider a company like Unilever. Imagine Unilever has sponsored a sports event, some FIFA football tournament they sponsored, and they have spent $100 million. So this is their advertisement cost. Now, if you understand how many soaps Unilever manufacture, how many shampoos Unilever manufacture, or how many moisturizers Unilever manufacture, how many detergent tablets Unilever manufacture, will not have, any impact on this $100 million because this is a fixed cost. So any cost that do not change with a change in volume of production is called fixed cost. Isn't this very simple and clear? Is this clear? Then any cost that changes with a change in production, that means production changed, this cost also will change, is called variable cost. That means you are trying to compare this with production volume. Production volume increased or decreased? Cost is also increasing, decreasing. It is variable cost. Production volume increased or decreased? Irrespective of that, this cost is remaining same. That is called fixed cost. For example, imagine I have taken one factory on lease. Factory on lease. Monthly rent, say for example, 35,000 US dollars. If I produce one unit, what is rent? $35,000. If I produce 10 units, what is rent? 35,000. If I produce 100 units, 35,000 rent. If I produce 1 lakh units, 35,000 rent. If I produce 2 lakh units, but of course, that is subject to the production capacity. Production capacity, say for example, is 500,000 units. Below that, whatever I manufacture, my rent will be 35,000 only. So these fixed costs do not change, at least in the short run. So maybe after 5 years, my rental expense need not be same as today. That is a different story. But in the short run, month to month, week to week, probably sometimes year to year, these things will not change. This is the reason management accounting says, because fixed costs are constant. Because fixed costs are constant, they are irrelevant for decision making. So decisions can be based on variable cost or marginal cost. That means irrespective of fixed cost. Don't consider fixed cost. Anyway, it doesn't change. You understand? So basically, this is what the subject matter is. Now, look here. See, this purpose, significance, diagram, all these things you'll understand. A person with basic understanding of economics or basic common sense will understand this. On y-axis, revenue cost is given in terms of dollars. On x-axis, quantity, volume of output is given. And then the curves, that left to right, whatever curves are there, fixed cost curve is there, total cost curve is there, total revenue curve is there. Fixed cost curve is there. Total cost curve is there. Total revenue curve is there. Now, student will ask, then where is variable cost curve? Simple. The difference between fixed cost and total cost is variable cost only. Now, what is the difference between these two? Fixed cost curve is there. Total cost curve is there. Between the two, if you subtract fixed cost from total cost 200,000, fixed cost 150,000. Obviously, variable cost is 50,000. No? So now you look at it, there is one curve TC, total cost, there is one curve TR. Look at the point of intersection, where the total cost curve intersects total revenue curve, that particular point is called break-even point. So what is break-even point? Basically, break-even point can be expressed in two ways. Break-even point can be expressed in terms of number of units, or break-even point can be expressed in terms of dollar revenue. That means my cost will be recovered if I sell 5,000 units. So 5,000 units is my break-even point. This is units. My cost will be recovered if I am able to achieve $75,000 of sales. So either it can be expressed in terms of quantity, break-even quantity, or it can be break-even revenue. Both of them are known as break-even points. You understand? Now you can say, but Pavan sir, in x-axis only quantity is given. How do I calculate break-even revenue? Simple. Imagine if your break-even point is 5,000 units. And if your selling price per unit is $15. So something like this. Break-even point quantity is 5,000 units. Now selling price per unit is $15. Now you tell me break-even point revenue, dollar revenue. Simple, 5,000 into 15, no? 75,000. So, Pavan sir, is this break-even point? Yes. Pavan sir, is this also break-even point? Yes. Pavan sir, is there a confusion? No. First one is break-even point quantity. Next one is break-even point dollar revenue. So this is in terms of monetary terms. This is in terms of output. You understand? So basically, this curve is giving you an insight of how many number of units are to be sold to recover cost. Obviously, your common sense says if this is my point, if this is my, look here, if this is my break-even point, above this, if I'm operating, I'll get profit. Below this, if I'm operating, I'll get loss. Why? My cost is not recovered. If my cost is not recovered, I'll book loss only, no? If my cost is recovered, beyond that, I'll earn profits, no? So this you might have studied in your 10th class, 11th class also. This you might have studied in your basics of, economics. This costing, you call it, or management accounting, you call it. All these things have actually come from economics only. All these are economic equations. Okay. So this is the diagram. After that, the importance of cost volume profit analysis is given here. The importance, but we'll see later. Now, important terms. Fixed cost. What is fixed cost? These are the costs that do not fluctuate with sales or production changes. Examples, rent, advertising. This is what I told you. Then variable cost. These are the costs that change as the quantity of products changes. Examples of variable cost include raw material cost, direct labor cost, etc. So raw material consumed, direct labor expenses, all these are variable costs. Sales volume. Volume means number of units sold. This is the number of products that business sell during a specified period. That the business sells. That the business sells during a specific period. Okay, so what is fixed cost? These are the costs that do not fluctuate with sales or production. Examples, rent, advertising, variable costs. These are the costs that change as the quantity of product changes, as the quantity of production changes. Examples of variable costs include raw material, hello, production, what happened to you? Examples of variable cost, raw material, direct labor, sales, volume. Then selling price. What is selling price? The amount customer pays to the company to buy a product is called selling price. Then two important things are given here: margin of safety ratio. All of you read point number 5 and 6 once. I'll explain what it is. So here, your break-even quantity is 5,000, okay? What is your break-even quantity? 5,000 units. During, say, for example, August 2023, X Limited sold actual sales or planned sales is 7,000 units. Now you tell me, what is your margin of safety? Are you safe? Yes. Why you are safe? Because you are able to sell more than break-even quantity. If you sell beyond break-even quantity, you will get profit. If you sell less than break-even quantity, you will incur a loss. Because here planned sales is 7,000, which is more than break-even sales. Are you safe? Yes, sir, I am safe. What is the margin of safety? 2,000 units. So can I say margin of safety is equal to planned sales minus break-even sales? Margin of safety is equal to planned sales minus break-even sales. So what is the meaning of this margin of safety 2,000 units, you know? That means before incurring loss, your sales can fall up to 2,000 units. Now, in this situation, your accountant came to you or your store supervisor came to you running, and then he said, sir, number of units sold decreased by 100 units. You will tell, okay, still I am safe. Why? My margin of safety is 2,000, no? So if the number of units sold reduces by 100, I'm still fine. I'm still safe. What if your accountant came to you running and said, our sales volume decreased by 1,000 units? Little concern. Sales volume decreased by 1,900 units. Concern. Sales volume decreased by 2,000 units. Oh my God. My profit completely wiped out. Sales units have fallen by 2,001. I am in loss. So this margin of safety 2,000 units is there, no? This is the cushion. Even if there is a fall up to this 2,000, still you are in profits. Still you are in profits. Beyond that, you will start incurring losses. So this is called margin of safety units. Now, what is margin of safety ratio? Simple. Margin of safety ratio is equal to the percentage by which sales can decline before break-even point is reached. So this is nothing but margin of safety sales divided by break-even sales. 1 second. The margin of safety ratio shows the percent by which sales can decline by planned sales. We'll check this formula once again. Don't worry about it. Margin of safety ratio, formulas are given down. Don't worry about it. We'll learn all the formulae and then we'll learn, problems also. We'll solve problems also. So now tell me, do you understand these important terms: fixed cost, variable cost, sales volume, selling price, margin of safety units, margin of safety ratio? So these are the 6 points. Theory, pure theory. There are no formula involved till now. Till now, we have not started solving any problems. The next step is called these assumptions and all these things we can come back later. Next important thing is this one. Very, 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 very important. Okay. So I suggest you to copy this in your notes. Contribution margin income statement. This is called contribution margin income statement. It's called contribution margin income statement. Copy this. contribution margin, income statement. Write down particulars, amount rupees. Amount rupees or amount dollars based on whatever is given in the question. You can write amount dollars. Contribution margin income statement. This is basically marginal costing statement. Okay. So do you remember here I gave you this equation? We started with the sales minus cost. Then I said cost is classified into two, variable cost and fixed cost. So what we are doing is we are taking sales less, instead of subtracting total cost, we are subtracting variable cost first. And the balance is called contribution margin. From that less fixed cost. Then this is called operating income. Okay. Do you know what is the nickname of operating income? Do you remember EBIT, earnings before interest and tax? Sales less variable cost, that gives you contribution margin. Less fixed cost, that gives you operating income, EBIT. Okay. So copy this. After that, there are so many formulae. We'll come back to those formulae later. And then after all this discussion, I have given test your knowledge. Because in CMA US, you'll have so many MCQs. So all this theory, whatever theory we have discussed till now, from that I have given so many questions. All these questions are covered in the class. This is only for your, revision. Then there are some problems and solutions. This we'll see. Okay. Aditya, are you there?
Yes, sir, I'm there.
Yes. Can you read problem number 1, please?
Yes, sir. Company X sells 10,000 units at a sales price of $40 per unit. Variable expenses are rupees 12 per unit and fixed cost total $2 lakh. Prepare contribution margin income statement.
Said this is the question. Okay. Normally, if you're from India, Pakistan, Bangladesh, where we follow rupees, this we read 2 lakhs. But when you go to Europe or when you go to UK, if you say lakh, they do not understand. They do not have lakhs. They do not have crores. So we follow thousands, lakhs, crores. They follow thousands, 100,000s, millions, billions. Okay, so in global course, it wouldn't make any difference. But in global course, or when you are speaking with professionals globally, you will not read this as 2 lakhs. You will read this as $200,000, which is same. $200,000. Okay, so company X sells 10,000 units, sale price 40, variable expenses 12 per unit, fixed cost total $200,000. Prepare contribution margin income statement. Okay, shall we do it? Put the heading contribution margin income statement. Under that, write down particulars, amount in dollars. First, we'll write sales. 10,000 into 40. Sales 10,000 into 40. So can I say it is $400,000? Huh? $400,000. This is sales. Less variable cost. Variable expenses. Less variable expenses. Okay, they said per unit variable expenses $12. So I sold 10,000 units into $12 each. That makes it 120,000. That makes it 120,000. So contribution is, can I say it is this minus this? 280,000 less fixed cost. Given in the question, fixed cost is given as 200,000. So operating income is this minus this. That's all, ladies and gentlemen. Ta-da! That's it. This is your solution. So this is what we call contribution margin income statement. So basically, whatever the question is in CVP analysis or in marginal costing, we have to prepare this contribution margin income statement. Okay. Whether it is asked or no, we will prepare this because all the formulae that are to be applied, we use this particular statement. All the formulae that are to be applied, we use this particular statement. Okay. So with this, we completed this question number 1. $80,000 we got. So this is our session 1. Now what you are supposed to do is, I have given you this beautiful material. In that, CVP analysis introduction is given, one diagram is given. Then what is the purpose of CVP, which is nothing but importance or significance of cost volume profit analysis for making decisions is given. Then important terms, fixed cost, variable cost, selling price per unit, sales volume, margin of safety ratio, all these things are given. Then there are certain assumptions given. Then something about sensitivity analysis is also discussed, but this is not that relevant. But if you want, out of your academic interest, read this 3-4 bullet points. Okay, only 3-4 bullet points. Then contribution margin. Already I told you what this is. Contribution margin per unit. Already we have done. So I want you to read up to this. Okay, so up to this, if you read, and problem number 1, once again, if you solve, that will be our session 1. After that, I'll take you through various other formulae, certain other techniques, and then not advanced, not complex, but little level 2. If this is level 1, that is level 2, not advanced. Okay, so do you have any doubts in the topics we have discussed so far? If you do not have doubts, that's it for session 1, and I'll see you in session 2.